President Donald Trump enjoyed a major legislative victory on May 4th when the House of Representatives passed a bill to repeal and replace Obamacare. If the Senate and the House can reconcile their differences over the legislation, the savings on health care spending will pave the way for a major tax cut, stimulating the economy. The drama in Washington, D.C. has dominated the headlines, stealing the spotlight from recently released data, signaling that the economy is surprisingly strong. According to data released May 5th, the employment situation has not looked so good in a decade. The U.S. economy created 211,000 new jobs in April, and the official unemployment rate dipped to a 10-year low of 4.4%. Unemployment has not dipped below 4.4% since 2001. Average hourly earnings rose 2.5% at the end of April versus their level a year earlier. While you will still hear many TV pundits and politicians talking about wage stagnation, it is a fiction. After the Great Recession ended in mid-2009, real wage gains after inflation stalled for several years. Since 2014, however, real wages have risen sharply from $25 to $26 per hour. For most American households, real wages determine the ability to spend. So, it's a good sign for the economy that growth in employee compensation at the end of March versus a year earlier surged by 5.3%. In addition, personal income in April grew by 4.5% versus a year earlier, which compares favorably to the 4.4% peak during the last economic expansion. An individual's bottom line after taxes, disposable personal income, drives personal outlays, which fuel 70% of U.S. economic growth. Some pundits were disappointed that the latest data on personal outlays was not higher than a month earlier, but the year-over-year growth matters more, and the 4.7% increase year-over-year is robust. While personal income data month-to-month is sensitive to seasonal shifts, the year-over-year number is more important, and that longer-term trend bodes well for the broader economy. Meanwhile, the savings rate of 5.9% is strong, and it seems like Americans learned a lesson in the last recession, maintaining a materially higher savings rate. The U.S. Federal Reserve Bank is legislatively mandated with keeping inflation in check while encouraging growth in jobs. The U6 unemployment index is watched by the Fed when setting interest rate policy to stimulate job growth, and the personal consumption expenditures deflator is the inflation rate watched by Fed policymakers. These two key benchmarks are in line with recent Fed pronouncements, and that's good news. The PCED had risen sharply in recent months, but the Fed held off on raising rates despite the sharp increase. Last month's decline in PCED validated both the Fed's decision to hold off on an interest rate hike in March and the Fed's outlook for gradually rising rates over the months ahead. At 54.8% in April, the Institute of Supply Management's Index of Purchasing Managers in the manufacturing sector remained strong. A reading of more than 50 in this index means the economy is continuing to expand, according to the Institute. Note how the index slumped well below 50% during periods of strong growth in 1995, 1999, 2003, and 2013, but it dipped below 50% before the last three recessions, making it a good indicator of recessions. The new orders component of the ISM Manufacturing Index also remains strong at 57.5%, which is a sign that the level of new orders entering the pipeline at manufacturing companies remained strong. The Institute's survey of purchasing managers outside of the manufacturing sector, which accounts for about 88% of economic activity, came in last month at an extremely strong 57.5%. In addition, the new orders component of the index, a forward-looking measure of economic strength, hit 63.2%. This was important following last week's report that the U.S. gross domestic product for the first quarter of 2017 was just 0.7%. Some pundits had seized on it as evidence that slower growth is on the way. The strong new orders figure, however, indicates that no slowdown is on the way. The Standard & Poor's 500 index this past week hit a new all-time high based on all the good economic news. Stock prices have surged nearly 15% in the past 12 months, and the economic expansion is now 94 months old. If the Trump administration and Congress can get the health care legislation through the Senate without major changes, it could clear the way for a tax cut aiming to boost consumer spending and quicken the pace of growth in the U.S. economy, and that could boost stocks. However, this is by no means a sure thing, and stocks could decline if a tax cut does not get passed or if something else bad and unexpected happens. Still, the strength of the economy is continuing to surprise many investors, and the outlook for accelerating growth remains intact, regardless of the outcome of political wrangling in Washington.